Despite lagging U.S. stocks over the past decade, international stocks offer many diversifying benefits. Besides equity diversification, you can also get currency diversification. That's assuming, of course, if the fund doesn't hedge against currencies. But you also get, for those dividend-paying funds, some reduced reliance on U.S. dividend payers by going abroad. So today's audience requested ETF battle is a triple header between international equity ETFs from Franklin, Schwab, and Vanguard. Who wins the battle? Find out right after this. Well, this is ETF Battles, and I'm Ron DeLegge, and it's great to see you again. If it's your first time here, be sure to hit that subscribe button. And if you've been enjoying our content, also let us know by hitting that like button and posting some comments below. If there's a specific ETF that you'd like to see in our next upcoming ETF Battles, or a contest between a two ETFs, or maybe a triple or quadruple header, post those ticker symbols in the description section below this video or on our X feed at ETF Guide. Also, don't forget to visit the description section below. We've got links to viewer resources, along with links to our program judges, as well as our program sponsor direction. Lots of good stuff down there, so don't miss it. Today's ETF contest was requested by a viewer named Benedict, and it is between three ETFs focused on international stocks. We've got VYMI, LVHI, and SCHF. So how will this go down? Well, judging today's ETF triple header, we've got Shana Sissel with Banrion Capital Management and Dave Dierking with TheStreet.com. Judges, welcome back.
Thanks for having me back, Rod.
Great to be here.
Our four battle categories are cost, exposure, strategy, performance, and then we've got the mystery category where you, our judges, can surprise us with a mystery factor, something that you feel is important to today's contest. Our judges can also nominate wildcard ETFs, or they can opt for split decisions. I've got the scorekeeping chores. At the end of the program, we'll declare an overall winner. Keep in mind, none of the battle outcomes that we ever do on this program are predetermined or known in advance by myself or our judges. So let's kick things off with the first category, cost. Dave, please get us started.
Yeah, these three international funds really have some unique strategies, which I know we'll get to in a minute. But from purely a cost standpoint, the Schwab fund is the easy winner here. It's at 6 basis points. Vanguard, which usually is very much in these low-cost battles, actually comes in at 22 basis points, so it's significantly higher. And then the Franklin one is at 40 basis points, so kind of out of contention there altogether. I'll actually throw out a wild card here. If you're interested in dividend income, SCHY, which is Schwab's International Dividend Equity ETF, that a lot of people are familiar with SCHD, the U.S. version of the fund, and use that as a dividend income vehicle. This is just the international version of it. It comes in at 14 basis points. So if you're looking for just pure international exposure within these three funds, SCHF is the winner. If you want the dividend tilt to it, I would suggest SCHY.
Well, that's a strong start. Thank you very much, Dave. Shana, you're up next. How do you see it when it comes to cost?
I have also almost nothing to add. This is pretty cut and dry. It's the Schwab fund, 6 basis points expense ratio, virtually no spread, easiest to trade, most assets, nothing to add. Dave did it all for me.
All right, that takes us next to exposure strategy. Shana, you're still up, so break it down for us. Which of these three ETFs stands out?
So these are three very different ETFs. They're all international equity, but they are international equity in very different ways. So to start with the Vanguard fund, that is a passive fund. It is replicating the FTSE All-World Non-US Index.
FTSE.
FTSE. It's FTSE, right?
Yeah, they say FTSE, not FTSE.
All right, well. Whatever.
Footsie, you say tomato, I say tomato. It's actually, I'm guessing, Shana, that's probably your British accent coming out.
Oh, yes, that British accent. Mm-hmm.
Fitzy.
Anyways, So it is, it does not hedge currency, and it does have emerging market exposure. It's very passive. It has over 1,400 holdings. And so it is going to give you very plain vanilla exposure. It does have a yield component. It does select stocks based on dividend and the ability to pay a dividend, not necessarily what the dividend is. And then it scores the yield component. The score of the yield component takes into consideration profitability, and that's how it screens. Then let's look at the Franklin Fund. This one is my favorite. It's now I'm going to spoil the plot here, but this is going to be my winner. The Franklin one is different. It has a proprietary strategy the way that it does it. It's really looking for low vol and quality. It's looking for stability of the PE. It's looking for high quality kind of names. It has a number of different constraints to ensure that it's fully diversified. It constrains the position size to 2.5%. It constrains the sector by 25%. It constrains country by 15% and region by 50. So it's got some great constraints in there to keep it diversified. It is a proprietary approach. It is much more concentrated than the other two with only 135 holdings. It doesn't really have a yield component, but it happens to have the highest yield of the three. And as far as its distribution rate is concerned. So, it really is doing something where it's taking a, systematic proprietary approach, which I would argue is active management. And it is looking to provide exposure to international equities in a diversified way, but through selection. And then finally, the Schwab fund is as plain vanilla as the Vanguard fund, but with even less screens. Where the Franklin fund has EM exposure and also hedges its currency, which the other two don't, the Schwab fund has no EM exposure. It is just doing developed markets, ex-US, the FTSE, developed market index. And so it's only developed markets. It does not hedge its currency. And it doesn't have a ton of constraints. It's market cap weighted. It can get really out of heavy in certain sectors and countries. And so it's giving you like a traditional index approach to international where market cap weighted, with major sector and country bias. So for me, for strategy, I like LVHI. That is my winner of this category because it takes a good, unique approach. It's systematic. It gives you that good diversified international exposure and higher quality. And then you get some yield for it as well.
Got it. Dave, you're up next. Your chance to give us your analysis on exposure strategy. So break it down for us.
Yeah, I see it largely the same way. SCHF is pretty much your standard index fund. LVHI, I do like the fact that it includes the quality screen on there. It looks at both technical and fundamental factors. So you're getting kind of more of a robust approach to security selection in that fund. And it specifically is looking for including some sustainable, long-lasting yields in there, even though it's not specifically part of the strategy. So like Shana said, it actually throws off a nice little 4% yield in there as well. So it's kind of comparable to what you might earn in other individual international funds. I'll actually say that I'm not a big fan of VYMI or VYM, its U.S. counterpart, because I think the strategy is just a little too loose on this one. It basically is taking a universe of stocks, ranking them by yield, and then just taking the top half and putting them into the fund. So that's why you get so many holdings in this fund. I'd argue just somebody who's in the top half of high yield doesn't necessarily qualify always as high yield. I'd like to see more of a dividend yield screen or something like that to really target high yields. I think this is a little too vanilla for my liking for an international dividend fund. So that being said, I'll go with LVHI as my winner in this category, although I'll give a shout out to SCHY again, because it also employs some of those quality screens. It tries to limit volatility. And it actually does have a high yield component in there, even though the yield at around 4% is similar to the other ones. So it also has kind of that quality tilt, which I think is useful when you're investing internationally. But within these three funds, I'll go with LVHI as well.
All right, got you down for LVHI, and thank you for those added details on dividend and dividend screening. I know that's your wheelhouse, Dave, is dividends, and that's your area of expertise. So really great to have you weighing in on that front. So that takes us next. What's that?
Try to help out where I can.
Yeah, well, we appreciate that. That takes us next to performance and yield, and I don't know if we should even have yield, but we're going to throw it in there just to have it as a comparative analysis. But Dave, you're up still. Give us your take on this particular category.
Yeah, I mean, the yield isn't all that dissimilar across all the funds. They're mostly within kind of that 4 to 5% range. So the exception being SCHF, it's a little bit of a lower yield. You're about 2.5%, 3% there. So if you're specifically an income seeker, that might tilt your choice away from SCHF. But on a total return basis, LVHI has performed better than both the Vanguard and the Schwab funds in the past. The standard deviation and the beta on these funds, if you're looking at volatility metrics, are also lower than the other two. So risk-adjusted returns are even better than the absolute returns. So that low volatility objective with LVHI is certainly showing up in these numbers here. So I will go with LVHI as my winner in this category too.
Thank you very much. Shana, you're up next. How do you see it when it comes to performance and yield? I'm
going to get on my soapbox a little bit here.
Because
there's two things that bother me a lot when people evaluate funds. The intense focus on expense ratio. I got to get the cheapest. And the intense focus on, I want to have a passive with a lot of holdings because then I won't lose out, right? So LVHI breaks both those rules. It has the highest expense ratio and the least amount of holdings. And it absolutely crushes the other two performance-wise. I looked at distribution yield because I wanted to try to get like to like with my numbers. And when I was looking at the three funds on their individual homepages versus, some of the other tools that are out there from a comparison perspective, VYMI actually doesn't give you a yield on their homepage, which is odd considering it's a high dividend fund. It gives you the distributions, but it doesn't actually write anywhere what the SEC yield is. And I didn't want or care to go and try to find it. So I went to a third party source and I just compared the three and used distribution yield because both VYMI and SCHF don't have a quote unquote dividend yield on the third party site. So of the three, LVHI has the highest distribution rate at 6.79%, VYMI at 4.5%, and then as was pointed out, SCHF at a little over 2.75%. So it has the best yield, the best performance, and it breaks all the rules in that it's highly concentrated with 135 names and has the highest expense ratio. But this is a perfect example of look beyond the fees and look at net of fees on everything. Like the fees only matter if it is taking too much away from the returns. But if you are producing returns, you have every right to charge a little bit more for that skill to do so. And the Franklin Fund absolutely has earned the right to charge a little bit more for its strategy because it crushes the other two, but still gives you like good diversified exposure to the asset class.
Well, thank you for getting on your soapbox and slaying some sacred cows, Shana. Well done. That takes us next to the mystery battle category. This is where our judges can take a certain factor or thing that they think is crucial to today's contest, highlight that, and bring it to our attention. So, Shana, you're still up. What is your mystery battle category, and which of these three ETFs wins it?
So I'm going to stick with LVHI, and it's my winner. But what I want to point out is this idea of hedging currency. So it is the only fund of the three that hedges currency. And this is an important consideration. We can debate whether or not hedging currency makes sense. But when you're investing abroad and you're investing in a lot of different stocks that trade in a lot of different currencies, you have currency risk associated with it. Whether it be because you are investing in USD or because they are not in USD, that conversion rate matters. So the hedging of the currency can provide a smoother ride in many ways. And if you are a USD investor, hedging so that you can have that stability can be, something that's worth doing. Funds that don't hedge currency need to think about currency, and the two funds in this in this battle that don't hedge currency aren't actually thinking about currency in any way. They're just not hedging it and also not taking it into consideration. So if you're not going to hedge currency, I want an active manager that's thinking about currency as an aspect of stock selection. But that is not the case here. So for me, I'm going to have LVHI as my winner. And it's because of the fact that it is thoughtful and it's hedging the currency, which allows for it to achieve its goals, which is to provide investors with high quality, low volatility returns to the international equity space.
Dave, you're up next. Break it down for us on your mystery battle category. What is it, and which of these three ETFs stands out?
Yeah, within these funds, I wanted to look at the quality factor of each one of them, and you can probably kind of sense where I'm going with this one. LVHI does, I think, a nice job of this, looking across a number of fundamental factors, looking at quality screens, valuation metrics, things like that, in order to make sure that you're sort of weeding out some of the garbage. And I think that's important to think about when you're investing internationally, because you look at a lot of ETFs and they'll quote, in some cases, single digit PE ratios. And you might think that that's terrific. And that means you're limiting downside and there's a lot of upside. But you got to remember that a lot of these deep value names are deep value names for a reason. And there's a lot of junk in there, and their business model may be broken or just nobody wants to own them. So just because something has a low PE ratio doesn't necessarily make it attractive. And you look across these funds, and I think their PE ratios are somewhere around 10 or 11 or something like that. So that's why I think it's important to sort of layer on a quality screen on top of these, so you kind of weed out some of that junk. Within these three funds, I think LVHI does the best job of that. And again, I'll give a shout out to SCHY because that also layers on the quality screen. So if you're looking for a dividend tilt, that's a nice way to go. With that fund, if you look at like ROE and ROA and debt to equity, they're all significantly better than you'll find in some of these other funds. So if you could pull out some of the higher quality names within this deep value space, I think that makes a lot of sense. So within these three funds, again, LVHI does it for me.
Well, that brings us to the part of the program where our judges can give us their overall battle winner. So Dave, you're up. Break it down for us. Who's your winner?
Yeah, it's LVHI again. I just like how it takes kind of a more comprehensive approach to security selection, looking at quality and fundamentals. And as Shana mentioned, the currency hedging, I think, takes a degree of risk away, and I think that's beneficial when investing internationally. Returns have been better. You got some good yield on there, too, if you're looking at that. So as far as an all-around package, I think LVHI is my winner.
Shana, your final chance to weigh in with your overall winner.
Yeah, I agree. I wanted to have a cool wild card I could throw in here. Fun fact, I used to run an international equity fund for Mercer. So I'm very familiar with a lot of players in this space, but none of them have ETFs. So doesn't really help in an ETF battle. When I look at this, LVHI is my winner for all the reasons we've talked about, for everything that Dave said. I just think it's a well thought of and a thoughtful approach to international equity. The hedging of the currency, it has emerging market exposure, it has attractive yield, has strong performance. I mean, in a market where U.S. equities were up double digits, this fund was up 20% plus in the last year. So it's not like it didn't perform and give you something. Maybe it didn't perform in line with U.S. equities, but as a diversifier, it still added value. So yeah, I agree. LVHI is my winner. It breaks all the rules. It has the highest expense ratio. It has the smallest asset base of the three. It's over $1 billion, so it's really not that important. It's just highly concentrated, but I think it's the right approach, and that shows up in the returns. It beats the other two in every time period for the life of this fund.
Well, our judges have spoken, and according to our final battle scorecard, we've got a winner of LVHI, and our judges agreed pretty much across the board It was almost a clean sweep for LVHI, with the exception of cost. SCHF won on that front. But as far as the other categories, LVHI was the agreed upon winner, and our judges raised some great points. We also slayed some, thanks to Shana getting on her soapbox, slayed some sacred cows. That it's not necessarily the ETFs with the lowest expense ratio and the broadest diversification that are necessarily the best investments. And we've got LVHI with the highest expense ratio. It's also got the most concentrated investment portfolio. And it's still won because of all the reasons that our judges highlighted. So well done to both of you. We couldn't have done it without you. And we look forward to having you on our season 6, upcoming season 6 ETF Battles in 2025. This will be our final episode of 2024. It's been a great year. And again, we're glad that you've been part of the ride with us for season 5. And we look forward to seeing both of you in our upcoming season.
Thank you.
It is great to be here.
Well, if you'd like to see a certain ETF contest, be sure to hit us up in our comment section below with your ETF ticker symbols. Make it good. You can also hit us up on our X feed at ETF Guide. And again, that's your homework assignment. Don't ask me what the ETF battle ticker symbol should be. That's your job. So you give us those ticker symbols. We'll take a look at it. And if you see another ETF battle suggestion by another viewer that you think we should do or makes sense, just hit the like button and that'll tell us what you want to see. Also, be sure to check out the description section below. We've got links to our program judges, as well as a link to our program sponsor, Direction. So be sure to check that out. Thanks for watching ETF Battles. I'm Ron DeLegge. We'll see you on the next episode.